Welcome to our YouTube live, and so this is just my take on what the Fed's just said, and let's just start off with the overall summary. So they didn't change rates. That's pretty much what markets were expecting, but that's the pattern we've seen consistently for almost the whole of Powell's tenure, which is if you look at what markets are expecting for this meeting, they very seldom don't do what the market thought. And what the market thought this time was that there wasn't going to be a change. Now, the one thing which they did talk about changing potentially is the policy over the course of this year. So that's definitely in the Fed's opening statement now, that they are talking about cuts this year. Of course, it's still data dependent. They could still reverse, but that's the central case now. Also in this meeting, we got an update of the summary of economic projections, which is not a forecast, but it is a outlook based on what the committee members, the FOMC committee members, expect is going to happen to the economy and to their policy in future. So that'll be an interesting update, which we'll dig into. Generally, the economic situation, is one where the US economy is growing quite strongly, so more than 3%. And certainly in the UK, we'd be pretty jealous of that. We'll be talking about the Bank of England tomorrow, so I suspect quite a different story there. Inflation coming down more quickly than in the UK, so more disinflation than we've got in the UK. There was a little bit of a hiccup when it comes to inflation in the last two prints. So this is for January and February. So we've had several months where inflation in the US has been coming down very sharply, as people expected, given the policy, the very tight monetary policy. However, in January and February, things got a little bit bumpy, as they described it, as Powell described it, where the numbers didn't fall as much as expected. The US is still ahead of the curve when it comes to other countries, other developed countries, but still, that was worrying for the Fed. He thinks it might have been seasonal effects, but that's one of the reasons why he said it was good to be cautious and not to jump the gun and try and cut rates too soon. So it actually validates their decision not to cut earlier. So certainly the last few data points, not so good. But the labour market tightness is easing, as we'll see in a moment. And generally, things are good with the US economy. So it seems very much like they have got a soft landing. Not many people are going to disagree with that now. Whereas just 6 months ago, there was a real question as to whether they could achieve that. So that's certainly a huge accomplishment by the Fed. And who knows, maybe even the Bank of England will be able to achieve something of a smooth landing. Although in the UK, of course, we have dipped into recession. The US has been nowhere near a recession. So we have kind of dragged the belly of our plane on the runway, whereas the US hasn't really landed at all. So that's great for the Fed. So let's just go through some of the data that that kind of fed into this decision, because I think that's the interesting part. And we can start with the expectation. So every time the Fed has a meeting, I kind of go through in the morning and look at what the market's pricing in for what's going to happen to Fed funds in the future. So this was as of February 2023. And as we scoot through these, just look at the date of the first cut. So in February 2023, the market thought that the first rate cut would be in November of 2023. Clearly, that didn't happen. Then it got to July of 2023, then September of 2023, December of 2023, March of 2024, June of 2024, and July of 2024. And then suddenly people got super optimistic and thought that the Fed would cut in March of 2024. Not only that, but they'd have a cut at every single meeting except for one until December of this year. Now, I just thought that was ridiculous because, yes, inflation was coming down, but it's never a smooth ride. And the Fed was going to be very cautious about its rate cuts. And sure enough, that's kind of what we saw. So the markets this time around, I think, have capitulated to a more reasonable expectation, which is the first cut in June, which I think isn't out of the question. Personally, I think it'll be more towards the end of this year. But then there's going to be a cut every other meeting. which again I think is a little bit too punchy, but probably closer to the truth, depending on what happens to the data, of course. If inflation surges again or the labour market looks soft, one of the things that Powell was talking about in the press conference, yes, of course, that would mean that they could reverse their policy. So I think the overall tie colour situation, which I always try to monitor, and Laura's very disappointed by this, my partner Laura, which is that he seldom wears his grey tie. It's almost always, and I think this is his hawkish tie, he almost always now wears his purple tie, which is his dovish tie. In fact, almost every meeting he's been wearing this tie. So she thinks as someone who's on the stage, the public stage all the time, he should try and change what he wears. Although, if you watch my live streams, you know I wear this top continually for these live streams. So now let's move on to the summary of economic projections. And this is the dot plots. And it's kind of notorious because I think people read too much into this. But it is a great way of communicating what the board members, the assumptions are for what's going to happen to the economy, but also what's going to happen to their policy rate. So what you can see here is the median of what the members thought would happen. This is the kind of central case, the typical projection. And you've also got a central tendency and a range, so you can see the dispersion of the estimates. And generally, you can see that the beliefs about US growth was that it's going to be slightly above trend for the first 3 years, 2024 to 26, and then the longer run will be 1.8, fairly typical for a developed economy. Unemployment is going to stay at around 4, which is pretty close to the long-term average and close to the longer run, which the committee expects. Inflation is going to be down to 2.0, which is their target, and it's PCE inflation, personal consumption expenditures inflation, which they target. That's going to pretty much get there by 2026. And in fact, it won't be far above it by the end of this year, which is looking quite reasonable, as we'll see in a moment. And core inflation, a little bit higher, 2.6 for 24, down to the target in 2026. And then finally, the Fed funds rate projection. If we compare it to what they said in December, you can see that the end of 2024 hasn't changed, but for 2025, it's been revised up slightly, and for 2026 also. So maybe they think inflation's a bit more sticky than they thought. Maybe that's the January and February numbers, which made them get a little bit more hesitant about cutting rates. But certainly there aren't huge changes compared to what we saw in December. The growth forecasts have actually increased a bit. The inflation numbers are pretty similar, a little bit higher for 2024, and the projected rates are actually a little bit higher, but not hugely higher. So not massive changes in the outlook, but of course the path that the economy followed was pretty close to what the Fed expected. So this is what it looked like in December if we summarize the path for the policy rate. So each of these dots is the expectation of one committee member. And you can see that they get quite dispersed towards 2025. So one person was at something like 5.75%, and another person was all the way down at maybe just a bit more than 2.5%. If we look at that now, you can see that I've also written in the numbers based on, so the black number is where we were in December for the expectations of the policy rate. The red number is as of today's meeting. And you can see that they have generally moved down a little bit for the 2024 and then up a little bit for 2026, but no huge shifts. And the long run moved up a tiny bit, but I wouldn't read too much into that. So generally, the outlook hasn't changed a lot. However, I think it's fair to say that the labour market in the US is still pretty tight. There's still this mismatch between demand for labour, which is very strong, and supply of labour, which hasn't been as strong. Although Powell did stress the fact that immigration certainly helped provide some of that labour force. A lot of people in the US are employed in customer-facing roles, And that's why the pandemic hit really very hard, because lots of people work in the restaurant industry, in the food industry, lots of people in customer facing roles. And when the pandemic hit, clearly that had a huge effect on the labour market. But now what we see is that if we look at the number of unfilled job vacancies per unemployed person, it peaked at about 2 jobs for every unemployed person. Now it's fallen to about 1.4 jobs for every unemployed person. So it's still pretty tight, still way above where we were in 2019, pre-pandemic. But it is starting to normalise. And that means that wage inflation will probably ease as the tightness of the labour market eases. And that means inflation probably eases as well, core inflation. If we look at how that usually corrects, usually it takes one of these grey bars, US recession, in order to get that vacancies per unemployed person to come down. Because if you have a recession, there's less demand for workers, people get fired, and there are less unfilled job vacancies. But at the moment, we still have quite a few unfilled job vacancies in the US because people have lots of demand for goods and services, which companies are struggling to satisfy with employees to do the work. If we look at non-farm payrolls, this is probably the most important number in finance, and I'm always banging on about it, but this is the number of jobs which the US economy adds every month. So it's in thousands of people. So you can see the effect of the pandemic here. There was a huge fall in payrolls, and currently the latest print was 275,000 workers, which is a very strong number. 100,000 would be normal, although maybe not, as we'll see in a moment. But generally, US total non-farm labour is increasing pretty strongly and has been for a long time now, since it troughed sometime in 2020. The point I'm making, if we zoom in on that, so you can see the latest number of jobs added, and that was for February, was 275,000 workers. It's been bobbing along between 210, 290. There are a couple of low prints here at the end of last year. But generally, it's been adding about 260,000 jobs per year for a fairly long period of time. And there's a question about the number of people that have to be added to the labour force just to keep employment constant. So as people leave school, leave university, emigrate to the US, how many new jobs do you need to create? Previously that was assumed to be 100,000, so that's the lower line here. There was recent research done which suggests that it might actually be 200,000 now. So the new neutral rate might be the higher dashed yellow line, in which case that doesn't make the labour market look quite so tight. But really it depends on the levels of immigration, and because immigration's so high, that number has actually been higher and may now be higher on a very long-term basis. So this might be a structural long-term change in the US economy. However, the nightmare for any central bank is that you get this price-wage spiral, and that's not what we're seeing in the US right now. So if you look at CPI inflation, that's the yellow line, that's come down very sharply. This is what the Fed was worried about. It fell, but the disinflation, the falling rate, kind of stopped for the last few prints. So 1, 2, 3, 4 prints, I'd say, suggests that the rate of inflation, the headline rate of inflation, is not falling at a reasonable rate anymore. So the quick wins, which came from energy, supply chain disruption, are now past, and we've just got the hard graft, which is to get wage inflation to come down. If you look at earnings growth in the US, the latest annual increase for that was 4.3% over the last year. And you can see that's way above where we were in 2019, which is what most people assume is normal, which is around 3%, 3.1%. That's what you'd expect. But 4.3% is very high. And that's going to have consequences for services, because services are driven by wages, the cost of services. And if wages are growing at 4.3%, that's not consistent with the Fed's target. So until the demand and supply of labour come back into balance, which they are starting to do, as we saw, the labour market isn't as tight. This sticky wage growth is not going to go away. An interesting point which Powell made today was talking about the balance sheet, because there are two aspects of monetary policy. One of them is the one that they've always done, which is interest rates. They set interest rates higher when there's too much inflation, like now. To stimulate the economy, they cut rates. Quantitative easing, which is when they buy bonds and hold them on the Fed's balance sheet, was the new innovation at the financial crisis. But it's like a drug which they can't wean themselves off. So they're trying to shrink the balance sheet. The worry at the moment is they're actually trying to do that too quickly. So if we look at the size of the balance sheet, it peaked at about $9 trillion. And this was following several rounds of quantitative easing. After the financial crisis, we got QE1, 2, 3, 4, which was the pandemic. And now we're starting to get the balance sheet runoff. And they're not selling bonds like the Bank of England. They're just letting them mature. That's what they call runoff. And that way, naturally, the size of the portfolio that the Fed holds will shrink over time. And that's now shrunk by about 16%, so over $1 trillion since its peak. But the worry is that this is reducing the amount of reserves which banks hold. And if those reserves become too scarce, you can get a disruption in money market funds. Now, if you watch my content, you know I talk about money market funds a lot. They're considered to be the safe part of the banking, of the investment system. If you want to take very little risk, you park your money in money market funds. A lot of those money market funds depend on reverse repo with the Fed. So if there is a disruption in these deposits, and there's a scarcity of deposits, then it can make these rates surge, and that can create a problem for money market funds and liquidity in money market funds. It can disrupt the commercial paper market. It can cause outflows from money market funds. So a whole world of pain follows. So the Fed is actually now talking about slowing down the rate of balance sheet shrinkage. And that's to avoid the reserves running too low. So they're monitoring it very carefully, because that's not the kind of disruption they want at the moment. They just want a smooth ride and a gradual shrinkage of the balance sheet. But certainly that's one of the policy changes that Powell was talking about today in the questions at the end. Core inflation certainly is falling. So if we look at CPI core, so this is the consumer prices inflation. This is what people usually look at. It's not what the Fed looks at in detail. They prefer the other measure, which we'll see in a moment. But if you look at US core inflation, it does seem to be progressing pretty well. I think in the UK we'd be jealous of that. But for the Fed, it's a bit worrying that CPI for the last two prints has been spiking slightly. And if you look at the month-on-month changes, you can see what they mean. So if you look at the monthly price changes from January to February of this year, almost every component was positive. So gasoline went up, airline fares went up, utility gas service went up, transportation services went up, almost everything. Year on year, that's not true. So there were deflation in gas service, airline fares, fuel oils and gasoline, used cars and trucks year on year. But the monthly numbers were actually ticking up. And this is probably what spooked the Fed. Could be seasonal, could just be a bump in the road, as he said, or it could be a sign that things are getting worse again, which is not what the Fed wants to hear. This is the measure that the Fed actually looks at, which is core personal consumption expenditures inflation and headline PCE, and that is coming down. So you can see that it's been over a year now when you've got successive falls in core PCE inflation, and that is reassuring. So personally, I think the worries about headline CPI are probably less important than what's happening to core. Because remember, the reason why we look at core is it's a better predictor of future inflation because you strip out the volatile stuff. And if we look at services inflation, you can see that that is still very sticky. Compare that with durable goods. So this would be like your car. non-durable goods would be the gasoline that you put into your car. Both of those have gone down to roughly, well, close to zero compared to the spikes we saw previously, whereas services inflation hasn't really subsided that much, and that's because wage growth is so high. So you've really got to get labour market demand and supply back into balance in order for that to go away. If we look at the Fed's, if we look at market expectations about inflation, so this is looking 5 years ahead at 5-year inflation. So 5-year inflation, 5 years in the future. And this is used as a measure of how the market thinks inflation's going to pan out. Currently, it's not far above the Fed's target, which is 2%. If this really starts to get out of hand, then it shows that markets don't think the Fed's got inflation under control. However, that's not the case. So the Fed remains credible, and that's good to see. And the Fed also uses they also use surveys of consumers, businesses, to see what expectations of inflation are, and those also show that the Fed's credible. So people don't expect inflation to stay high. They're not going to anchor on that likelihood, which means that it doesn't become a self-fulfilling prophecy that inflation stays high. Because if people expect it, it happens. You negotiate stronger wage growth, you raise your prices as a company if you think your input costs are going to stay high. So it's really important that people's expectations are managed, and it seems as if the Fed's pulled that off. There is a question about tighter conditions, and I always show this graph because it shows that overall conditions, according to one of the Fed's own measures, are easing. So credit conditions are actually getting easier as markets rally, as credit spreads stay tight. And that's kind of contrary to what the Fed's saying, which is that credit conditions are tight. But overall, it does look like easing according to this measure. But as Powell said, there are multiple measures of financial conditions. And if you look at the labour market, the fact that we are starting to see a slowdown in the rate of hiring and demand for workers suggests that their medicine is working, that conditions are tightening where it matters, but maybe not as quickly as they'd want. Right, so that's the end of the of my kind of summary of the economy and the stuff that the Fed looks at. At this point, we'll pause so that the dog can come upstairs and have a treat, and also for you to think of some questions. Now, don't forget, we're going to do another live stream tomorrow. Please do like, please do subscribe if you enjoy our content. Some of you do. So please do hit the like button. It helps us a lot. And also, let's just see if there's anything else I'm supposed to say. Otherwise, I'll be in trouble with Laura. Let's have a look. I can hear the dog. Nope, there's nothing in the document. Brilliant. So, here he comes. Hello. I've taught some really good tricks. I wish you could see them. He can roll. He can stand. He can shake. He's really good at that. Nothing useful, of course. He can't rebalance my portfolio. But you would if you could, couldn't you, Ted? Here we go. You have one more. Very good. You're a very good boy. Have one more. Not too many, because you'll be sick. Is that good? Good boy. He's very good. Do you want to go back to Laura? I think she's got some biltong. She's going to rattle it in a minute. Laura's going to rattle the biltong. Because this stuff's buffalo, and I think he prefers the biltong. Nope. She hasn't rattled it. Yes, if you are a subscriber, if you are a supporter on YouTube, then we'll push you to the front of the queue for your questions. If you are doing a super chat, obviously it helps us financially if you do that, so please do. We'll push you to the front of the queue, and we will answer questions for a bit, say till past. So we'll have about 20 minutes of questions. If you have questions, you may not, although we always seem to. Brilliant. Let's have a look. Oh, okay. So it's interesting. People usually ask investing questions. They don't ask about the Fed, which is amusing. First question's from Anthony Valente, who says, "Evening, Ramin. I hope you're well." I am. Thank you, Anthony. May I ask your take on the recently launched Amundi Prime All Country World ETF, WEBK? Do you think it has the potential to compete with the likes of VWRP and FWRG? Yeah, if you're not aware of it, we were talking about it on Slack in the membership today, and I was just taking a look at it just out of interest. Let me pull up the notes I made on it. Yeah, so this is, share my screen. Yeah, this is the fund in question. Yeah, WEBG, that's the ticker. And of course, the net asset value is tiny at the moment. It's only just been launched a few days ago. So about, absolutely tiny at the moment. But the thing which has got my interest is the ongoing charge, which is 0.07. Now that is very good. That is a very good ongoing charges figure. How did they manage to get it so low? Well, I think one of the ways they did it was not to pay a big licensing fee to MSCI or to FTSE Russell, because what they've got is the selective GBS Global Markets Large and Mid Cap Index. If you haven't heard of it, neither have I. So I suspect what they did is to cut costs by having a less popular index, which is costing them less to in terms of license fee. Because the way they do it is they pay a license fee to an index provider, and then they can copy those weights for a passive fund. So by reducing the cost of that, they've minimized the cost of the fund to run the fund, and that minimizes the cost to you. Another interesting thing about the fund is that it's an income fund. But a lot of these global funds, the new ones, are accumulation funds. The way I think of it is most people who are in the accumulation phase of their investment career probably want an accumulation fund because they don't want to reinvest the coupons. But in this case, it's an income fund. So it's an interesting choice from Amundi. I'd like to know why they did that. But still, distribution. And another interesting thing is it's domiciled in Ireland, not Luxembourg. And that means the withholding tax is going to be 15% rather than 30%. And it's physically replicated, so they do have to pay withholding tax. If it was synthetic, they wouldn't pay withholding tax at all. But still, this is physically replicated. It's domiciled in Ireland, so the withholding tax will be low. It'll be something like 15%. And because it's dominated by the US, 60% is US, that pays a dividend of about 1.5%. So you'll get to keep 85% of that because it's domiciled in Ireland. So the tax treatment is also favourable. We have seen another Amundi fund which was Luxembourg based, and that actually is going to be a drag on return because it pays a high withholding tax of 30%. Was there anything else to mention? I mean, usual suspects, if you look at the top 10, it's going to be the same companies, right? Microsoft, Apple, Nvidia, Amazon, the Magnificent Seven, and of course Eli Lilly. Now, apparently some of the PensionCrafters in Slack, when we were discussing it, some people said it wasn't available on UK platforms yet. So until it is, I'm not going to add it to my list of cheap funds for members, but I think that's just a matter of time. But is this going to compete with FWRG, which is the Invesco one, Invesco Global Fund? Yes. So this is the Invesco one. Actually, that's the London Stock Exchange listing. Let's see if I can find. Yeah, here we go. So this is the one that was recently launched by FWRG, and also an ETF like this. So on an ETF only platform, if you want a global fund, I thought FWRG would be the one. But it looks like there is going to be competition for that space. Because imagine, every investor in the UK for their core equity exposure will want something which has global equity exposure. So it's going to be a very commonly used product. So the competition is going to be really fierce in this space. So let's have a look at FWRG's page. Can you? Yes. Here we go. It's called FWRA. Not helpful. It's FWRG. Should be because I own it. Yeah, FWRG. Yeah, this is the one. And the fee for this one is 0.15%, so pretty low, but nothing like this one, which is, half the fee. So if I had the choice between the two, it's difficult because I want an accumulation fund. I wouldn't go for income, I don't think. It's a little bit of a pain to have to reinvest. Maybe that's another way they cut the fee. Maybe it's more expensive to manage an accumulation fund. Maybe it's easier to distribute, although I doubt it. But that was the only downside I saw to the fund, which is that it's an income fund. If there was an accumulation one, then no question, if I could, I'd buy that one. But at the moment, early days, hopefully it'll make its way onto UK platforms, and I definitely think this is a contender. And it's really exciting to see this, competition between providers in the UK to provide the cheapest global fund. This one's cheaper than the VT fund from Vanguard, which they never managed to replicate for UK investors, which is their global ETF in the United States, which always got my goat. So it's reassuring to see Amundi do it. So thank you, Amundi. But this is just a part of what markets are like now. There's just really tough competition between all of these asset managers to get the low fee core ETFs, make them available to investors, and then just hoover up assets into the cheapest fund, as has happened in the US for decades now. We've only just become more price sensitive, I think, in Europe and the UK. But now that we are, fund managers are responding to it by creating these cheap funds. So that's great. I think that's really good for us as investors. Any super chats? No. Greetings from California. Oh, how lovely. This is from Andrew Meline. I used to live in California. I lived in LA for many years. I know California very well. I learned to drive in LA. Took my driving test at the Hollywood DMV. That was a scary experience. There we go. Phil Curtis. UK stock market overall isn't really going anywhere. And an increase in business insolvencies in the UK. Is there any positive news? Yes. My portfolio is doing very well. You'll be pleased to hear. So as you may know, I just bought some single stocks. I bought a combination of small cap, value, quality, momentum stocks, combination of those factors, because there wasn't a fund to do it in the UK. So I just made my own. And I've got 2 stocks from each sector. So I've tried to diversify across sectors. I used Stockopedia I used their filters in order to create that, their screens. And it's been doing okay. The rebalancing is quite expensive though. If you rebalance the portfolio, I discovered, because the bid offer spread on those small caps is so big, it gives up a lot of the gains every time you rebalance. So I'm going to rebalance infrequently. But certainly if you're selective about the stocks you buy, I think it's looking good in the UK. It's cheap. The economy is doing okay. I mean, it's not a deep recession. It's just kind of teetering on the edge of recession. And of course, the time to buy isn't when things are good. It's when things are bad and valuations are low. So I still think there's a little bit of upside for the UK ahead. Otherwise, I wouldn't have gone overweight UK in my fund portfolio. But overall, I agree the economy is not in great shape. Maybe if we have a change of government, there's going to be a shake-up. There'll be certainly Labour's making a lot of the right noises. So, for example, the OBR, the Office for Budget Responsibility, which takes the fiscal and monetary policy, puts it into their models and comes up with growth forecasts, inflation forecasts, debt forecasts. They're going to have a bigger role in determining policy. So whatever they think is going to be growth positive will be more likely to become a policy for the government, which I think is a great thing. It really shouldn't be a partisan issue as to whether you invest in the economy to stimulate growth. That should be everyone's policy. Unfortunately, the parties can't agree on what that should be. So outsourcing that to a semi-neutral body like the OBR is probably a good thing. We'll have to wait and see how it actually pans out. It may be that they just don't have enough money to do that because UK growth, it's a bit of a catch-22 because growth is weak. The taxes are low as a result because taxation depends on GDP growth. And so it's difficult to actually pay for the stimulus in the first place. So I think you've got to run up a bit of debt in order to get things going. But Labour are really averse to doing that after the trust budget. That's just stayed in people's minds, fortunately, so it won't be repeated. But I think they're now a little bit too cautious about increasing expenditure and stimulating the economy and focusing too much on debt to GDP when, if you look at the US, yes, their debt to GDP surged to 120%, but I think a large part of the reason why they've got a growth of over 3% and we've got 0 is that we didn't stimulate enough. We were much more focused in the UK on things like furlough schemes, keeping people in work and not getting them fired. Whereas in the US, their attitude was, well, look, people are going to lose their jobs temporarily, but what we're going to do is stimulate the economy, create new jobs, and it worked. They've recovered very quickly and they've recovered to a higher level of GDP than they were at before, which is pretty impressive. So I think there are lessons for us there as well in terms of policy, fiscal policy, how the government spends. Next question. I think we did have a member. Okay. No question. Is the countdown new from Mama and Harry? Yes, it is. I was very excited by that because one of our members, I think it was a comment on YouTube, they said, why don't you add... But what it means is that the transition's a bit smoother at the beginning. Usually I'm sitting there going for the first 10 seconds of the YouTube live. So it just avoids that because I can just switch screens in OBS. It's a lot smoother. So please do like and subscribe. We've got another 7 minutes together and we've got a super chat. Woohoo! Thank you for that. We've got a question from 1234 Renegades. What sectors would benefit the most in decreasing interest rate environment? Are REITs a good place to rotate to as the Fed rates go down? Yeah, I mean, generally it's going to be the rate sensitive sectors. So that's going to be things like banks. So a steeper yield curve is going to be good for banks. They tend to borrow at the short end, they lend at the longer end. So that net interest margin will increase. So it's going to be good for banks. And unfortunate because I've just sold my US banking sector ETF this week for a 28% profit. That was a good call. I bought it when we had the Silicon Valley Bank shakeout because I just thought banks were unduly beaten up and that worked really well. But I've sold it now because I just thought, well, it's gone back to the level it was at before the Silicon Valley Bank bankruptcy, liquidation, insolvency. So that's why I did it. But that's one sector. So the financials would be one. Another one would be, like you say, real estate. If interest rates are lower, then you'd expect real estate to, have a bit of a comeback, if not a surge temporarily. anything related to the housing sector, so whatever feeds into it, things like the timber industry, which US houses use a lot of in order to construct the framework for the house, glass manufacturing, any kind of home building equipment. Lennar, for example, is one of the stocks which provides that industry. So those are the ones I'd be looking at the moment, if you are going to try and play that one. Yeah, or growth as well, because growth stocks tend to do well when interest rates are lower. Although that's kind of happened so much already, I think it's going to be difficult to push those valuations higher. But those are the sectors which are currently quite beaten up, where I would expect a big bounce back if rates start to fall consistently and sharply. But I suspect what the Fed is going to do is a more gradual approach, where they cut at most every other meeting, and if it is going to be a cut, it's going to be 25 basis points, pretty small cuts, and then they'll reach a stage when they wait and see to see if inflation spikes, and then they'll carry on cutting if things are okay. Cautious, I think, is most likely. Question from Simon. Do you think he was 90 seconds late because he was choosing his tie? Well, no, because he always wears the same tie. He never changes it. What's more remarkable, actually, is he doesn't get gravy on his tie. You know, whenever I worked in banking, and I had to wear a tie, you go out to lunch, it's almost guaranteed you're going to get gravy or food on the tie. But he never does. Or he's got multiple ties with the same colour. I'm not sure about that. But it was a dovish one today. That much I know. How are we doing? We've got 4 minutes. A couple of questions. And another super chat. So thank you. 2 super chats. One's from LC. Thank you very much. The other one's from Glyn. So LC says, I have a couple of dividend payments if stocks in my ISA on Trading 212. When reinvesting the dividends, does this add to your ISA 20k limit? No. So the 20k limit on individual savings accounts is on new money. So once it's in there, it can grow to any size, and there's no effect on the amount that can go in for that year. So the limits on how much can go in. Compare that with the SIP, where there was a cap on how much you could put in. It was just over 1 million. That's going to be scrapped. Labour will probably put it back. But for the ISAs, there's no cap on the amount. There's a cap on how much goes in. But to become a millionaire with an ISA, you need about 20 years of maxing it out, and you'll probably get to 1 million if you do some sums. If it's a stock portfolio, for example. So no, it doesn't count towards your 20k limit if you're reinvesting the dividends. Next question is from a YouTube supporter, and that's Glyn. Sorry, yes, it's not a super chat, it's a YouTube supporter, which is Glyn, who says, I'm thinking of consolidating ISA funds, ETFs, into VHVG. If you're not aware, VHVG is Vanguard's developed global equity fund. So it's developed only, so it doesn't have emerging markets. This is the one I use for my core as well. Let me see if I can find it. Here we go. Just so you can see the fund. Move my face. Here we go. So this is the accumulation version, which is VHVG. There's also an income version if you want to be paid an income. This was already on Vanguard, but they've just released about 30 funds, which are accumulation funds on their platform. A long time coming. So now we've got accumulation versions of almost all of their funds, including their money market fund. So you can see it's the same fund, 2,133 stocks in it. The only difference is that this one's an accumulation one. And what I like about it is the fee, which is very low, 0.12. Compare that with VWRP, which does include emerging markets. So see, this one is only developed world. if we go for VWRP, which is an accumulation fund again, it's global and it doesn't appear on their search. Global equity. How are we going to find it? The search isn't great. What we offer, full list of funds, building my own, equities, global index accumulation, VWRP. This is it, FTSE All World, I think. Yeah, VWRP, and the income version is VWRL. Notice the fund charge here is much higher, it's 0.22. So that's why I went for the developed world one. Stripping out emerging markets only takes away about 7% of the index, so it's not going to massively affect the return, but it does massively affect the fee. So that's why I went for VHVG. But going back to your question, which was, you're thinking of consolidating into VHVG. I like the fund. Currently arbitrarily running 3 or 4 all-world US ETFs funds, but will be tidier all in one. Any thoughts? Any risks or pitfalls? Well, if it's in an ISA, then there's no cost of switching in terms of capital gains or tax charges. Most platforms nowadays are very cheap to trade, if not free. There's a bit off the spread, of course, but very low fee to switch. The risk of being in one fund, in my opinion, is very low, because with an ETF, you're the beneficial owner of the actual stock, of the actual stuff in the fund. And that means that if the fund manager goes into liquidation, what will happen is they'll just hand over the fund to somebody else in order to manage it. And so I'm not that worried about being concentrated in one fund. If you are paranoid about that, if you are scared of that, then of course you can put it into multiple global funds. I just don't think there's any point. I think it's very unlikely that they're going to go into liquidation, the fund manager, particularly Vanguard. But if that is a worry, then yeah, you could split it. Personally, I don't. But other pitfalls, I can't think of any. I mean, it is hugely diversified, so that's good. Is it risky in another way? I don't really think so. The fees are low. It could be that emerging markets will outperform, in which case you'll have a bit of FOMO. You know, if India just goes completely crazy or China comes back with a vengeance, then, you know, you could underperform. But, you know, that could happen. But because those are two countries which have small market caps still, they'd have to move hugely in order to move the needle. And at the moment, they're a drag on performance. So, you know, it could happen though. So it might be FOMO, you know, if you're missing out emerging markets. But overall, I don't think there's a big drawback. You know, I did that a while ago. I'm in one fund for my core, for 90% of my investments. My SIP, my ISA on Vanguard are all in VHVG, 100%. So, you know, I'm clearly keen on the fund. But I'm not committed to it. I mean, if there was another one that was cheaper, which did include emerging markets, I'd go for that. And Vanguard probably will cut their fees at some point because of this competition. Oh, and a huge super chat from G, Good Q, I think is the name, Good Q. Thank you very much. He says, they say, just want to say you're awesome. Thank you very much. Second time I make it to a live show. I'll watch it properly later, but came here to say hi. What a nice way to end. So thank you so much. Good Q. Anyway, look, thank you all for joining us. Overall, looking pretty good for the Fed. Looks like they're going to cut. They'll probably be the first central bank to do that. Maybe Switzerland will, but likely the Fed. Good growth, shrinking the balance sheet, maybe a bit more slowly, but overall looking pretty good from the Fed's point of view. It does look like a soft landing. It's going to be good for US stocks, good for the US economy. But of course, unforeseen things could happen, so we'll keep watching it. And thank you all for joining us. Tomorrow night we'll be doing this again. probably the same top. Thanks, Jerome. And yeah, we'll talk about what the Bank of England's going to be doing. Let me get the time for that. Don't want to get that wrong. So tomorrow it's going to be 6 o'clock because of course they have the meeting in the afternoon. Except this time I think there may not be a meeting because they haven't got a monetary policy report. Anyway, thank you all for joining us, and please do like and subscribe. Don't forget our membership. Go to PensionCraft.com if you want to join us, and you get access to lots of goodies, members only videos, Slack, so you can discuss things like the Fed or your circumstances with other members and myself, and get some accountability with other investors with a like mindset. Anyway, thank you all for joining us. Take care, and we'll see you again tomorrow at 6 o'clock.